Hey guys, it's Dan here. In this week's video we will talk about the topic why focusing on profits kills companies. Okay, so now I know what you're thinking. You're thinking, okay, that's clickbait and that's nonsense and all that stuff, and basically profits, that's the reason why a company exists. And I agree, you are right. But there's a little bit more than that, and especially if you're only focusing on profits, you are losing the big picture. So let me explain. I went to a business school for 5 years, have a master's degree in finance, and to shortcut it, what you learn in business school is basically what is the financial goal of a company. Well, basically there are two. First of all, maximize profits, and second of all, maximize shareholder value, which is a fancy term of saying maximizing the stock price. Why maximizing the stock price? Because you want your investors to be happy, and of course to press the like button for your company. So the reason why I make this video is to show you, to explain you with an example, that profits are a wonderful thing, but you need to have a bigger picture to not miss out on the big stuff that could really kill your company. So let's get started with the example, guys. So now first of all, let's draw a beautiful picture. We will talk about profits only, and you will see in my communication that everything sounds very good if we focus on profits only. Let's imagine I'm a company and I sell these great pens. By the way, this video is not sponsored by the pen maker here, but it's just to give you an example. So where do we find profits? We find them in the P&L, in the profit and loss statement. If you are struggling with financial statements, I made an entire video about all the financial statements, balance sheet, profit and loss, and cash flow. So make sure to check it out if you want to learn more about financial statements. Now let's talk about profits, and imagine I'm this company here. So I would say that in my profit and loss, of course, I start with the revenues. I made 100 of revenues this year, minus my personal costs of 30, minus my material costs of 25, and minus other operating costs of 5, which was, let's say, it was my rent. Okay? So this stuff leads to an EBITDA of 40. What is an EBITDA? It's earnings before interest, taxes, depreciation, and amortization. Fancy term to say operating profits. And by the way, it's easy to remember this EBITDA because it's earnings, so profits before interests, before taxes, before depreciation and amortization. Okay? So you will see that most companies, and when you look at company statements, they will emphasize on EBITDA growth and EBITDA numbers. Okay, so we're gonna do the same here. And of course, after EBITDA, there's a lot of stuff coming: depreciation and amortization, which is the loss of value of a machine, for example. Then you have interests, of course. If you have loans, you pay interest on loans. Of course, you have taxes because you are a business, unless your name is Amazon. And you have, of course, one-off items, which are non-recurring items. I will talk about it in a minute. And all this leads to net profits of 8. And you will see that usually companies do not really communicate about net profits, and I will talk about it in a minute as well. So what I would do here in this case, if I wanted to pitch this company or talk to investors, this is what I would say. And if you Google different companies in the S&P 500 or other stock exchanges, you will see this is how they do it. So they would say, well, first of all, great news, our revenues went up by 10%. Last year I only had 90 of revenues, this year I have 100, so my revenues have increased by 10. So that's a great first sign, right? And then of course I was able to control all my costs, beautiful. And this one leads to an operating profit of 40, an operating profit margin or an EBITDA margin of 40%, which is better than last year. Last year I made 35%, this year I made 40%. I'm the best CEO in the world, you know. This is how you would present these things. And of course, if you stop here at this metric, EBITDA, which is the most communicated metric, you could say, wow, fantastic company. Big operating margin of 40%, revenues are going up, profits are going up, amazing company. Well, let's continue the example now by bringing in other metrics which are not related to profits, and you will see the difference. Okay, now now, because we are very smart people, we are not stopping at just looking at the profits, but we want to have a look at the cash flow as well. So let's try to find out what's going on here. So here is my cash flow on the right side, and we will walk through it very simply. First of all, my revenues. Are my revenues the same as my cash ins? Are the revenues, so my sales, is it the same stuff as what I get on my bank account? Theoretically, yes, but there is always a delay. So this is one of the biggest reasons why profits are very tricky. And look at this one here. You have revenues of 100 because you did a great job. You sold more of these great pens than last year. So you have revenues of 100. The problem is that inside your cash flow, you were only able to cash in 80 of these 100. Why? Because some suppliers paid you later, or some suppliers did not pay you. So this is why out of 100, only 80 stick right now. This is the first problem. Then everything is more or less in line. Personal costs become your personal cash outs, because your employees want to be paid the same months, obviously, as they have worked. No problem here. And then your material costs of 25 turn out into material cash outs of 25 as well, because you were good to your suppliers and you paid them on time and, let's say, quickly and correctly. Then you also have your rent, your other operational costs. Of course, your landlord is not waiting. That's why you have other operational cash outs, which are the same, -5. And then comes the rest. And this is why a lot of people love to communicate about the EBITDA here, because it's such an easy, great looking number. The thing is, in the cash flow, and especially in the operating cash flow we're just walking through, there are other things factoring in. So everything that goes out as a payment goes into your operating cash flow. And you will see why this makes a big difference. Because here, below the EBITDA line, so I was blind here because I don't care, I'm just looking at the EBITDA, there are interests, expenses, which of course turn into interests payments, because of course if I have a loan to a bank, I owe money and I'm gonna pay interests. So it's going through my cash flow. For the taxes, the same. Of course, the tax authorities are not waiting for 5 years. So if you have taxes in your profit and loss because you made gains, so you have to pay taxes, of course you will find your taxes here. And then the tricky part, and that's why I was talking about the one-offs at the beginning. Let's imagine here, you did a great job by controlling your personal costs, but you did a little trick to show a great EBITDA here, and I've seen that in many companies, and that's a great trick. Now let's imagine I'm rolling out a new software this year, a new ERP system or something like that. I'm gonna work with consultants, obviously, right? I'm not gonna hire new people that I'm gonna pay for the next 5 years only to roll out a software for 6 months. Well, the thing is, that's the tricky thing. Because let's say you are paying a fancy guy to roll out the software for 6 months, it's gonna be a non-recurring expense, right? So it's not gonna be in your operating costs because it's non-recurring, it only happens once, but it's gonna be in your one-off items. So way below the EBITDA line, nobody cares about that stuff because we are looking at this beautiful number here, right? But imagine here that your one-off items of -12 are your consulting fees for this software implementation. Well, guess what? You have to pay these guys, obviously. That's kind of a hidden salary, if you want. That is not counted here because it's on the bottom here, because it's non-recurring. But of course, as you have to pay these guys, they're gonna show up in your cash flow. So here, bam, -12. So if we do our 80, which are less than our hundreds of revenues because we did not manage our cash ins correctly, our clients did not pay us fast enough or not paid at all, for example, and we have all these costs, all these cash outs coming below, well, we are going out with an operating cash flow of -2. So actually, what looked beautiful here in the EBITDA, in our operating profits, well, in our operating cash flow, it looks a bit darker. Let's put it like this. We're going from 40 to -2 because of all the reasons. And we are not stopping there, and that's another big drawback of the EBITDA. So first drawback was we don't see the cash impact, right? There are a lot of cash positions that are not in the EBITDA, for example, my consultant here. Second big drawback of EBITDA is that we are not reflecting investment, okay? So as a company, I want to stay up to date. I need to invest in a new software. I need to invest into innovation to stay up to date with my great pens, right? So in this example here, I paid 8 into my investing cash flow. So I spent 8 of, let's say, 8 million or whatever, for great innovation into these pens and into my new software. So this is also something you paid, and at the end of the day, if you take your operating cash flows of -2 minus your investing cash flow of -8, you land with what is called a free cash flow of -10. Free cash flow, that's something you should always consider. That's super important to remember that and look at this number, besides the profits, of course, because the free cash flow tells you if a company is cash generating or cash burning. That's super important. Look at Uber, for example. Uber has been burning cash since the beginning, actually, 1 billion per year or something like that. In this case here, the free cash flow number is negative, which means we have burned cash. If it was +10, we would have generated cash. So what have we learned so far? EBITDA gives you some kind of indication, but not enough, because it's just operating profit. First of all, it's just profits, and second of all, it's just operating profits, so there is a lot of stuff below. Then we have learned that when you convert this stuff into cash, a lot of things show up, and usually they show up uglier. So EBITDA does not reflect your cash needs, that's very important. And it also doesn't show you the investing needs you have. So that's why you should definitely always check out the free cash flow. I made a few videos about it. Check them all out if you want, especially one where I'm comparing profits to cash flow, for example. Now that we have talked about the limits of profits, because it's not showing your cash needs, it's not showing your investing needs, there is another need that is not shown in the profits, and that's the following. When you look at the balance sheet, which is the third financial statement, you will see there are two categories, assets and liabilities. Assets is what a company owns, liability is what a company owes to someone, for example, to their shareholders, or for example, to a bank. What is very important here and what is not shown in the EBITDA or in the revenues or generally in the profits is the debt level. That's very important, because I think you can easily understand that it doesn't matter how many profits you make and how much cash you burn or you generate, your debt level is extremely important. Because think about it, let's say you make 40 of EBITDA and you have 500 of debt, it's a totally different situation than if you have 200 of debt, you know? Your debt level is super important, because where I come from, and usually in the financial world it's like this, you have to pay back your debt at some time. So let's draw a quick conclusion here. Remember, the topic of the week was why focusing on profits kills companies. Well, let's quickly sum up what we have learned in this video. First of all, when we look at the P&L, what do we see in the P&L? Well, we can see revenue growth, and we can see EBITDA growth or operating profits growth. All this stuff is important. You should go for these things. These things are important for a company, of course, but not enough. And especially if you're only focusing on these things, at some point you're going to run into a wall, or as an investor, if you're only focusing on this, you will also get a nice surprise in the future. So why is it not enough? Well, because the profit and loss doesn't reflect the following three very important things. First of all, in the P&L, you don't see the cash needs or the cash performance. As I just mentioned earlier, this stuff, the cash needs, you can only see them by looking at the cash flow, especially at the free cash flow, because the free cash flow tells you, is my company generating or burning cash? That's super important, and in my opinion, that's the most important metric you should look at when you're analyzing a company, let's say if you have only a minute or something like that. Second point, the profit and loss doesn't tell you your investing needs. You know that check out the cash flow as well, check out the investing cash flow, and check out the story of the company. How are they innovating? Do they bring new products to the market and these kind of things, because you don't want to invest in an outdated company, of course. And then third point, which is also important, the profit and loss doesn't show you the debt level of a company. It's not the same if a company has 0 debt, 1 million of debt, or 500 million of debt, of course, because at some point you have to pay back the debt. Debt level, very important. Where do you see the debt level? Well, you see it in the balance sheet. In the liabilities section, check out debt, and especially check out the variation compared to the last couple of years, for example. Is the debt going down or is it going up, and does it make sense? So now that you know all that stuff, I hope this was very helpful. Don't forget to like the video if you like that kind of stuff. I also wanted to tell you that I post once a week every Sunday. So if you like corporate finance, market finance, don't forget to subscribe to my channel. I'm also on Instagram, Stan the Finance Man. See you soon, guys. Have a great week. See you. Bye bye.